Okay, so welcome to our live mentorship session for financial reporting and by extension corporate reporting students and joining the party because everything in financial reporting is valid in corporate reporting, so you get the opportunity to have these two sessions generally coming in for you to help you to pass the examination. And in the next 12 weeks, we are going to be spending the time to guide you, provide you with the blueprints that you need in order for you to put yourself in the position to go into the exam hall and pass the examination. I believe that everyone on the call is familiar with the interface when it comes to Microsoft Teams. So in your interface, there is a chat there. If there is any question you have, something you want me to share my thought on, whatever it is, as class is ongoing, you can put it in the chat. Or if you can also talk, then you can raise your hand. You see the in the interface and the reaction, you see the love or the heart emoji, you see thumbs up, you see thumbs down, you see raise your hand, a symbol like this, raise hand. If you click on that, I'll be able to get the notification here, and then boom, I'll bring you up in so you can ask your question. Don't hesitate. Don't say that you're going to be dragging the class back or whatever. If there is anything you don't understand as we are going, as we are discussing, just put it in the chat or you raise your hand, I'll bring you up so that you'll be better guided so you can prepare well for the examination and most importantly, pass the exam. On today's discussion, we're going to be getting excited straight up into, a 20 marks area in the exam hall. So it's not just like we are just coming here to, do some quick talks and go away. No, we are getting excited into a 20 mark straight question coming in the exam hall that we need to understand. But before I get goosebumps, it is important we lay some ground rules to help us to understand how to navigate this live mentorship session in the next 12 weeks to really help us to achieve our objectives at the end of the day, passing the examination. And so there are three things that I need you to be mindful of. The first one is to be present. And I beg you that you need to be present. Be present simply means that you need to be active here, taking notes. It's very important because passive learning guarantees your failure at the end of the day. So you need to be present here. Listen, you cannot multitask your way to pass the examination. If you want to pass the financial reporting or corporate reporting examination, you have to be here present. So if you're on the call, be on the call, grab your notepad, grab your notebook, grab your calculator, be attentive, and be ready and be active going through the program. Jenny, you are on the call and you are cooking banku in the background. You're on the call and you are chatting with your girlfriend or your boyfriend in the background. No, you have to be present here. If you have other things that you are supposed to do, then go and do that so that when you have the time, you can sit down and watch the playback. If you are watching the playback, same thing. I beg you, you cannot multitask your way to pass this exam. You have only one shot, and that one shot must count so that you pass the exam and go away. So be present. The second thing is you got to be involved. Why? Because assignments are going to be given. We will be doing performance evaluation tests, and it is important you get yourself involved. Please, do not come here, an assignment to be given, and you say, I am busy, I am this, I am that. No. The only way you can pass the examination is through practice, is through understanding, is through application, is through working with speed and accuracy, is through crystallization. And so you want to make sure that you are involved. Assignments will be given. Please make sure you do the assignments. We will do performance evaluation test. Our performance evaluation test is going to be on the live call like this. Your cameras have to be on, and then we will be doing the performance evaluation test. Make sure you participate. Get yourself involved in the program fully so you can pass the examination. So please be involved. We won't take any excuses. The reason why this is important, and almost everyone on the call here, you have read our terms and condition. The reason why we do mentorship and we don't teach is because the only way you can pass the examination is working on your speed and accuracy, handwriting, crystallization of the principles, and coming in with deeper understanding. And we get you to be able to be prepared for the exam through performance evaluation tests, assignments, mock examinations. And so I beseech you, brethren, that you get involved. The third thing is you need to discipline yourself. At least you got to commit between 8 to 12 hours every week to study by yourself. And we mentioned this in our orientation program that you need to prepare a study plan. And by now, I hope everyone on the call, you have prepared a study plan. You have prepared a study plan. And the study plan gives you the guidelines on what you need to do, what you need to study generally at the end of the day. So commit 8 to 12 hours every week to study on your own. I beg you. Don't sit down a week to the examination, take leave from the office, and think you can do everything in 1 week. You will fail the exam. So I want to let you understand, make it a point to make some sacrifices that will help you to pass the examination. You have to. You have to. Maybe it's 1 hour, it's 30 minutes, it's whatever, 2 hours. You don't have to sit down 2 hours to study. You don't have to sit down 1 hour, 30 minutes to study. Maybe sometimes it's just 45 minutes. Do it. Maybe sometimes it's just 30 minutes. Do it. But you need to do something by yourself if you want to pass the examination. Listen, you have to pass this examination. You have to. You have to, because that is your way out. You know the reason why you are doing this program. I'm not here to motivate you, because if you need somebody to motivate you to go after your dream, I think you are not serious in life in the first place. Because your life should be enough testimony to motivate you to go after your dream to improve your life. Some of you, your promotions are on the line. Your next job opportunity is on the line. Your next project is on the line. Some of you, you wake up every morning and you are insulting your boss. You wish you will not go to work, but you have to still go. And you are doing this program because you know you need to add value to yourself to increase your value in the marketplace so you can have some peace of mind in your life. That is enough testimony to motivate you to give it your best shot and make the sacrifices necessary so you can write this exam in November and pass the examination. I'm not here to motivate you, because you have to let your life be enough testimony to motivate you. So if you are waiting for somebody to be in suit to come and speak big grammar and tell you that it is possible, you can do it, I think you are living in la la land. But you need to let your life be enough testimony and say, I don't want this life. I want to change this life. How do I change this life? I need to do A, B, C, D. When? Now. If you can do that, make the necessary sacrifices, then you can pass the examination. So please, 100% involvement. You got to be present, be taking notes, be doing the calculation, be involved in the discussions, be present. Assignments are going to be given. Please make sure you involve yourself fully. Then commit yourself, promise yourself, do it. Every week, 8 to 12 hours, commit yourself, minimum of 8, up to 12 hours, to do something on your own by yourself. If you can do that, I can guarantee you, you walk to the exam hall on the 2nd of November, all other things being equal, write the exam with confidence, the results will be released by 30th of November, and you will pass the examination and take your life to the next level. You don't have to be on this journey for a long time. You don't have to feel miserable. You don't have to feel demotivated or discouraged. So your life is in your hand. And you have to decide from this day whether you want to pass or fail. Because there are only two sides to the coin. It is good, evil, wealthy or poverty, success or failure. You have to decide where you want to be. And be realistic with yourself. And go after your dream and do what you have to do to make sure you pass the examination. And so in order to help you do this, our toolkit will be, number one, The primary document of reference is going to be our book on the subject. I don't have the financial reporting here because we are waiting for new copies to be released, to be received pretty possibly tomorrow or whatever. We are supposed to receive it this week. But this is our corporate reporting book, volume 1, and the volume 2 is there. So we have this available. So that is going to be our primary source document. Okay. There are a lot of questions we're going to be solving. They are going to be coming in from the book. But like we say always, maybe you bought a ICAG manual or you have a book already on the subject. It's okay. 99.9% of the time, the things are the same. So you don't need to buy our book in addition. No. So if you have already bought a book, ICA book, or you've bought some books somewhere, it's okay. 99.9% of the time, the law is the law is the law. The material is the material. The idea is the idea. So you can keep it. But if you don't have any book, I will really entreat you to get our books on the subject because it's going to help you. We have a lot of questions in the book, and they will be our primary source document during this discussion. Then the second thing is the key summary videos, which you already have access to in the mobile application. So the key summary videos gives you the blueprint on the key areas that you must understand. And then we break down the topical issues. So especially those times that you are going to be doing self-study, to understand the principles of whatever topic you are going for, you go to the key summary videos. 5 minutes, 10 minutes, 12 minutes, 8 minutes. On the topic, you watch them quickly, grab the principle, then you can expose yourself to questions. So leverage the key summary videos. For 99.9% of you, your password to pass this examination is how you use these key summary videos. Because you don't have the time to sit down to rewatch a 3-hour video or something like that. But you know the topics that you are looking at. So just go to the key summary video, go to that topic issue, go to that standard, watch the principles, then expose yourself to questions. Then the last one is our practice question course. So we have our practice question course on financial reporting and corporate reporting. And the practice question course is meant to give you access to a lot of questions. Yes, if you want more questions to solve, you can download the past questions on the ICAG website and solve the questions. The solutions are there. You're going to be good. Or you can buy the ICAG question kit. That is also good. You see the question and the solution. It's perfect. But the practice question course gives you access to the questions, the solutions, which you can download and get access to, as well as the videos explaining the various things. Because one of the challenges of many students is that you see the questions, you have seen the solution, but you cannot make out how the question and the solution that has been presented. And that is where the practice question course comes in to give you that assistance where we pick questions and the questions are coming in from various sources, carefully selected, ACCA, SEMA, ICAG, ICAN, various sources carefully selected, broken down into the various topical areas to help you to really prepare well for the examination and most importantly, pass the exam. And so for most of you, I would really encourage you to get a practice question course. Some of you have already enrolled in it, but you can get access to the practice question course, and it will help you to add to your arsenal as you prepare for the examination. And so the question we then ask ourselves is, what's the syllabus structure? And what are we going to be seeing in the exam hall? There are 5 questions that the examiner is going to be asking us as always. All right. So 5 questions. We're going to be doing that in 3 hours and 15 minutes reading time. Boom. We are done. So what are these 5 questions that the examiner will be getting excited about? The question 1 is going to be consolidated financial statement. 20 marks. Every financial reporting student or corporate reporting student is excited about consolidation. And we'll come back to that because that is going to be our last but one topic as we proceed in the discussion. Question 2 is going to be on the accounting standards. That is the IFRSs or IASs that you got to be mindful of. 20 marks question waiting for us in the exam hall. It depends. There are going to be maybe 4 or 5 standards that the examiner will be bringing questions on. But in certain questions, you may have to call on 2 or 3 different accounting standards to be able to then answer the question. So that is question number 2, the accounting standard. But just linked to the question number 2, the accounting standard, is the single entity financial statement. Question 3, also 20 marks. Either the examiner will bring us statement of profit or loss and statement of financial position, or the cash flow statement. So one of these two guys will be there. Either the examiner will say cash flow statement or the statement of profit or loss and statement of financial position. But your ability to really prepare the financial statement is dependent on your understanding of the accounting standards. It's as easy as that. So if you are strong in the accounting standards, question 3 is au revoir mon ami, because I mean, it's not going to be rocket science for you at the end of the day. Question 4 is one of my favorite areas, and that is going to be interpretation of financial statement, ratio analysis, right? So we are going to be seeing a 20-mark question, financial reporting students, 15 sometimes for corporate reporting students, but we are going to be seeing evaluation of financial statements coming in the exam hall, ratio analysis and analyzing the ratios. Then the last one is going to be the issue about the theories. Question 5 is going to be theory in the exam hall. Okay? Question 5 will be theory. So for financial reporting students, this will be the area that you will go in for first in the exam hall. And I'll be repeating this throughout the discussion. In the exam hall, the strategy is to optimize your chances of passing the examination. And the way you optimize your chances of passing the examination is by finding out where can I get easy marks. So 20 marks question on theories will be in the exam hall for you when it comes to financial reporting students. Corporate reporting students also, same idea. You're going to have 20 marks question coming in on the theories. Now, the theories cover areas such as ethics, governance, conceptual framework, regulatory framework, the accounting standards, sustainability issues, integrated reporting, IT, information technology. So these are the 7 areas that you are going to be seeing in the theory area. Maybe 4 of them will be in the exam hall. Okay, so ethics, governance, corporate governance. The standards, you're going to see some standards there. Integrated reporting. Then you're going to be seeing sustainability issue. Okay. And then information technology. Yes, there is IT in here. Information technology. So depending on how excited the examiner wants to be in this question 5 mark area, just so you know, this is last semester, July 2026, financial reporting question 5. The A aspect was an ethics question that the examiner asked students for 20 marks. Sorry, for 10 marks. The B aspect of that question was an IT, 5 marks, cloud reporting to a company. So that was an IT-related question. Then the C aspect was an accounting standard question. So it means that last semester, the examiner went with IT, ethics, and IFRSs. So at least 3 or 4 of these issues will be in the exam hall. You have to know them. Then I didn't even add this, the conceptual framework and regulatory framework. So these are all theory areas, and certainly that's where we're going to be starting our discussion from today as we get excited. Corporate reporting students, everything there is valid. Corporate reporting students, your theory question will be spread across. So you're going to have some theories in question 3B. You are going to be having some theories in question 4B. Then you're going to have some theories in question 5B. So your theories will be spread across. But in financial reporting, the theories will all be put in question 5, minimum 20. But the question 2, the accounting standards, we can get some theory questions also there, because there are a lot of theories under the accounting standards as well. So you can even get some theories in the accounting standard area that you need to be mindful of. So this is the syllabus structure and how you are going to be structuring yourself out to pass the examination. Now, as I mentioned, we're going to be starting our discussion from the question 5 area, the theory issue. From there, we'll get goosebumps to question 2 and question 3. So we're going to be spending a significant portion of our time really on the accounting standards, because 70-80% of the questions you're going to see in the exam hall, you have to call on accounting standard, because the accounting standards will help you in consolidation. The accounting standards will even help you in evaluation of financial statements, or what we call ratio analysis. So we're going to be spending significant portion of our time really on the standards. And the key issue is that time will not permit us to finish all the standards in class. But I'm going to give you the breakdown of the various standards, and that's why we have the key summary videos available, so you can start watching some of the standards ahead of me. But the time will not permit us to cover all the accounting standard there is. But we're going to be doing upward of 90% based on our understanding and based on how we are structuring ourselves going into the examination. So that is what you need to understand when it comes to the syllabus structure and the examination. Any questions, you raise your hand, we bring you up, or you put it in the chat for me. Now let's come to the accounting standards, and let me give you a little breakdown on the standards. And I'm doing this because, as I said, we're going to be looking at the standards possibly from next week as we begin the IFRS masterclass, because today we're going to be starting with the question 5 area. But I'm doing this to help you in preparation of your study plan, and most importantly, understanding how the exam is going to be like. So when it comes to the accounting standards, this is the priority level attached to the various accounting standards. Financial reporting, corporate reporting students will be doing something about yours tomorrow as we meet. The first tier is what I refer to as the non-negotiable accounting standards. Financial reporting students, whether I like it or not, this is waiting for you in the exam hall. You have no way out, okay? It's waiting for you. And these standards are IAS 16, property, plant, and equipment, and IAS 12, income tax. These two accounting standards are waiting for you in the exam hall, okay? You cannot do anything about it. That's the truth. You cannot do anything about it. They are waiting for you. The second tier is what I refer to as the 3 angels, and they are highly examinable standards. These include IFRS 16 leases, then financial instruments. Financial instrument has 3 different accounting standards. We have IFRS 9, which is financial instrument recognition and measurement, measurement and recognition. Then we have IFRS 32, IAS 32, that is financial instrument presentation. That is normally for compound financial instruments. Then we have IFRS 7, and that is financial instrument disclosures. So 3 different accounting standards on a financial instrument, but that's the second of the highly examinable standards. And then the last one is IFRS 15, revenue. IFRS 15, revenue. So these 3 areas are highly examinable standards that you have to be mindful of. In other words, you cannot walk into any corporate reporting or financial reporting examination without knowing everything under leases, everything under financial instruments, or everything under revenue, IFRS 15, because that is very important, and that will help you to pass the examination. The third one are the non-current asset standards. Here is the play. Whether I like it or not, the question 2 area, financial reporting student, corporate reporting student, your accounting standard will be 30%. That is the whole of question 2, 20, and question 3A, 30. Whether I like it or not, there are questions that you have to call on the non-current asset standards. That one is also another guarantee that you can take to the bank, and you'll be able to walk away with a load of cash and go and chill. So, who pay? Who pay? Whether I like it or not, you will call on 2, 3, or 4 of these standards somewhere in the exam hall, either as a standalone question or embedded in other aspects of the exam. And these include IAS 36, impairment of assets, IAS 38, intangible assets, IFRS 5, non-current asset held for sale and discontinued operation, IAS 40, investment property, IAS 23, borrowing cost, and IAS 20 government grant. Whether you like it or not, 3 or 4 of these guys, you'll be calling on them in the exam hall, either as a standalone question, or you will call on them on the single entity financial statement, or in consolidation, or in the evaluation of financial statement. So your best bet is to know all of them. Oh, Nhyira, at this point, you are saying that all the accounting standards will be coming in the exam hall. No, that's not what I'm saying. What I'm saying is that you have to know everything, upwards of 90% before you go to the exam hall. That's what I'm saying. So there's nothing like, oh, dear, give me what is coming. No. There is no give me what is coming. There is no give me what is coming. There is learn what you are expected to know. When you learn what you are expected to know, you go to the exam or you pass. There is no give me what is coming. You have to learn everything. And your face, lazy boy, you can't sit down and come and say, and then the last year is what I refer to as the essential. These are the fundamental building block standards, and we can have questions about them coming in the exam hall that we need to be mindful of generally at the end of the day. And these include issues like IAS 2, inventories, IAS 8, accounting policies, changes in accounting estimate and errors, IAS 10, events after the reporting period, IAS 37, provisions, contingent assets, contingent liabilities, IAS 33, earnings per share, IAS 21, effect of changes in exchange rate, and IAS 24, related party transactions. So these are some list of the accounting standards that you have to know. Yeah, you have started counting them. Oh, Iradi, oh God, how will I know all these standards? No. The standards are symbiotic. The standards are like Siamese twins. Like they are joined together. They are intertwined. They are related. So when we begin our IFRS masterclass, you're going to see how we're going to symbiotically learn the standards. So it is not like you're going to say, Charlie, hey, I have finished learning IAS 23 borrowing cost. Allah will lie. Any question on IAS 23, I can solve it. We need to ask you a number of questions. Okay. Can you solve a question involving IAS 16, IAS 23, IAS 38 together? Like it's one question for 5 marks, but you have to apply principles from these 3 standards in one question. Can you do it? That is the symbiotic relationship that we are talking about. Do you get the idea? So the standards are interconnected with each other. So you're not going to learn them as a standalone and forget them. No. Whatever you learn in the non-current accounting standards, they are going to have relationship with each other. And that will help you to really understand them very well. And Nuntina, we recommended that if you are writing financial reporting, you are in level 2, and this is your first time, then you do that with public sector accounting and finance if you have not done public sector yet. Because in public sector, you have the IPSAs. In financial reporting, you have the IFRSs, and a lot of them have a lot in common, and that could help you to make the journey much interesting for you as you get yourself prepared and go into the exam hall generally. So that is what you must understand about the standards and the breakdown of the accounting standards. Any questions, you raise your hand, we'll bring you up, or you put it in the chat for me. All right. So that brings me to the end of my introductory pep talk on the subject. So you got to be active, be involved, be preparing your notes, be punching along, be engaged, be present. You got to give me your 100% assignment, performance evaluation test, mock. You got to make sure that you dedicate between 8 to 12 hours every week to do something on your own gradually. If you can do these, you're going to pass the examination. Because the most expensive commodity in the world is time. You can make the money back if you fail the exam, right? You can make the money back. But the time you wasted cannot be reversed. It's gone forever and ever. So you got to decide, how do you want to play this? How do you want to play this? Do you want to become a chartered accountant in 1 year or in 2 years? Or you want to take 10 years to become a chartered accountant? In my books, 1 year or 2 years, it's better. That's a better swag. You can focus on other aspects of your life, and you can become more successful as an individual at the end of the day. So give me your best in the next 12 weeks, and we pray that the grace of God and His peace will be with us, so that whatever we will do will turn out to be fruitful, so that by the time you get to the exam hall, you are mentally, emotionally, psychologically prepared to write the exam with confidence, so that when the results are released by 30th of November and you check that result, it will be above 50. That means you have passed the examination and you can take your life to the next level. But that will only work if you work. That's all. That's all. All right. So in that case, let's get excited into the discussion, starting with our first topical area. So as I said, we're going to be starting from question 5. So we're going to be going into the conceptual framework. So we're coming in from question 5. And give me a sec. Let me quickly also present this in the book before. So I'm coming in from the book as well. Conceptual framework. That is from page 11 of the book. Okay. From page 11 of the book. Because I'll be moving in between the book as well as my slide for my presentation as we proceed in the discussion. And so the conceptual framework provides us with the idea to have an understanding of the set of financial statements that entities are required to prepare and the objectives of those financial statements. Please give me a moment. The objectives of those financial statements. And so, what are these financial statements and what are their objectives? The first one is the statement of profit or loss and other comprehensive income. Please stay with me carefully. The statement of profit or loss and other comprehensive income is the starting point. It is assessing the financial performance of the entity. This is where we're going to be seeing the revenue, we less cost of sales, get a profit, then we get other comprehensive income. One of the challenges that the chief examiner has raised concern on relates to students' inability to even extract financial statement because they lack the understanding of the pro forma of the financial statement. And so it is important I walk you through quickly the pro forma of the financial statement as we begin the discussion. And you have to know these offhand because you are going to be presenting financial statements, whether in corporate reporting or financial reporting. So you have to know them. So I'm coming in from the book, page 54 of the book. The pro forma is there. So you're going to see revenue. And so this is where you're going to be applying your IFRS 15, revenue from contract with customers, to be able to call on how much revenue the entity can recognize. And we'll get into IFRS 15. Then it comes to cost of sales. This relates to the amount of cost the entity incurred to be able to produce the goods or get the goods from suppliers and make it ready for sale. So that is the cost of sales that is going to be coming there. It depends, but you need to understand that cost of sales is actually made up of the following. So in a typical manufacturing company, we're going to have the opening stock coming up. Then we will add purchases. Then we will less closing stock. Less closing stock. And that is what gives us the cost of sales. Sounds good? So now you must know this pro forma because it depends on the styling of the question. There are questions where you will go with a traditional format like this, cost of sales is there, then you go away. In other styling of the questions, you will be given the individual items, then you have to do your calculation and get your answer coming in that case. Okay, those of you, you do management accounting, you realize that there will be manufacturing cost coming in that case. But we have opening stock, we add purchases, we less the closing stock at the end of the year, then that gives us the cost of sales for the year. So that is the second item we bring. Now, when we subtract the cost of sales from the revenue figure, it gives us the first key item in the financial statement, and that is the gross profit. Again, this is important because when we get to evaluation of financial statement, one of the things you must understand in evaluation of financial statement is what is called common size or vertical analysis. If you don't appreciate the pro forma of the financial statement, if you are presented with the opportunity to undertake vertical or common size analysis for a company, then you're going to have a problem. So the pro forma is not just there for us to be able to answer question 3, preparation of financial statement, but it is also there to help us to appreciate evaluation of financial statements at the end of the day. Then we bring in other income. Yes, because companies make other income like the dividend that the entities will receive. Okay, so dividend that the entity will receive, maybe rent income that they will receive, interest income that they will receive, or other fair value adjustments coming in from assets of the company at the end of the day. So other income will come. Then we bring in distribution expenses, admin expenses, other expenses. Then we get a key line item again, which is called PBIT, profit before interest and tax. You have to be mindful of this particular thing because when we get to evaluation of financial statement, PBIT is going to be a crucial indicator we are going to be using to calculate quite a number of ratios. So you have to be mindful of PBIT, profit before interest and tax. Then we bring in finance cost. This is an interesting area because the finance cost we are bringing here can be from financial instrument, IFRS 9, or the issue in respect of rewinding or unwinding of discounted cost, that is IAS 37, and some other items that may come in. So finance cost standards are going to be coming up that you need to be mindful of. And that will give us profit before tax. Another key indicator you have to be mindful of when we get to evaluation of financial statement, how we arrive at that figure and how that figure is going to be used to do certain calculations. Then we come to income tax. Here come your best friend in the class. That is IAS 12. Income tax. So how much income tax can we recognize in the statement of profit or loss? It will be based on the application of IAS 12, income tax, where we'll talk about the current year tax, we'll talk about over and under provision of tax, then we'll talk about deferred tax as well as movement in deferred tax. So IAS 12 is going to take a center stage when we come to that particular area there, income tax. Then we come to profit after tax, also referred to as profit for the year. Another financial indicator we will be needing in the preparation and presentation of financial statement. So those relate to the day-to-day running of the organization. Then we come to other comprehensive income. The other comprehensive income is used to record transactions that are not part of the day-to-day running of the organization or transactions that the entity elect to recognize them in the other comprehensive income. And so things like revaluation of assets may come. Sometimes deferred tax assets may come here. Then other assets, other transaction or items may come. So this is the statement of profit or loss and other comprehensive income, which can also be called income statement in a simple language that we need to be mindful of. Please keep the pro forma, because the examiner has said this over and over again. Students have been in the exam hall and they have done the workings they are supposed to do, but the extraction of the financial statement became au revoir, mon ami. So you got to make sure that this thing is in your head for the rest of your life because you're an accountant. Then we come to the second item, which is statement of changes in equity. Now, the purpose of the statement of changes in equity is to tell us about the movement in the shareholders' fund. The movement in the shareholders' fund. Now, we will come back to shareholders' funds in evaluation of financial statement, but shareholders' fund relates to the share capital, the share premium, retained earnings, revaluation surplus, other components of equity. All those things under equity will be recorded in the statement of changes in equity. So you can see the pro forma here: share capital, share premium, revaluation, retained earnings, other components of equity. Now, one thing you must understand is that, among other things, the statement of changes in equity is going to be recording prior period errors. So if in the previous year there were some errors committed in the financial statement, and these errors are now recognized in the current year, then we correct those errors in the statement of changes in equity. And that means we will have to revise the retained earnings figure or any other equity item in the statement of changes in equity, because an error committed in the previous year cannot be corrected in the profit or loss. You get the idea? Cannot be corrected in the profit or loss. The profit or loss is this year, what happened. So something that happened last year, which we omitted, which we didn't record, which we misstated, if we want to now bring it into the financial statement or do the right thing, you can't do it in P&L. You must do it in the statement of changes in equity. Then dividends that the entity paid during the year, dividend is not an expense to the company. Okay, so dividend doesn't come in the P&L, statement of profit or loss. Dividend payment comes in the statement of changes in equity, and it reduces our retained earnings, and so it is going to be subtracted. However, the dividend that we received during the year, as we mentioned, that one, it will come in the P&L. If the entity received any dividend during the year, that will come in the P&L as we have what? Indicated. And these are the things that you must understand generally when it comes to that. Then, if we issue shares during the year, that will also come in the statement of changes in equity and other things. Profit for the year will come. So movement in the shareholders' fund happens in the statement of changes in equity. And the shareholders' fund is the summation of share capital. Now, share premium is the profit on the issue of shares. So if a company issues shares, okay, at say $10 per unit, per share, sorry, but the nominal value of the shares is maybe $8.5 per share. Now, the nominal value is the face value of the shares. That is what we will record in the statement of financial position under share capital. So if you check, the nominal value of the shares is 8.5, but we sold it for 10. The excess we get is profit from the issue of shares, and that is the 1.5. But we don't call it profit. We call it premium. It means the shares have been issued at a premium. So that premium is what goes to the share premium account. So the idea is that the 8.5 will be recorded in the share capital. Then the 1.5 will be recorded in the share premium. So the share premium records transactions relating to issue of shares at a premium. So then the question you'll be asking is, Nhyira, what if we issue the shares at a loss? It's also possible, right? So let's say that the nominal value of the share is $12.8, but then the share price We did an issue and we issue it at 10.2. Now, why is this possible? This is possible because it could be a right issue, because normally entities will make a right issue by issuing new shares to existing shareholders at below the current face value of the shares. So the nominal value is 12.8, but we are issuing it at 10.2. Quickly, somebody will say, oh, we have made a loss on the issue. Okay, what is the loss we've made? 12.8, 10.2, that is $2.6. In this case, we have two ways to deal with it. The entity can elect and say, if there is a share premium already there, then that loss will be written off against the share premium. If we don't have any share premium from prior year, then that loss will be written off against retained earnings. Are you getting the picture? These are crucial discussions we've already getting goosebumps on. So you got to be mindful of what's going on. So we issue the shares at a loss. Where do we record the loss? If we have share premium from prior year, then that loss will be subtracted from the share premium. But if we don't have share premium from prior year, then the loss will be subtracted from retained earnings. So it's more or less like we are giving more shares to the existing shareholders for which they are not paying as much money as possible. That is the idea about the share premium account. And that is what you must understand in respect of the statement of changes in equity. Any questions, you raise your hand, we'll bring you up, or you put it in the chat for me. Then the third thing is the statement of financial position. The statement of financial position tells us about what it says, the financial position of the entity. So what are the assets of the entity? What are the liabilities of the entity? What are the equity of the entity? So that's the statement of financial position. For all intents and purposes, we expect an entity to have a healthy financial position. So the financial position is going to be looking at the non-current asset first. And we'll get into some of this discussion in a moment, but we'll come to the non-current assets. Then we'll look at current assets. Now, non-current assets are assets whose economic benefit goes beyond one accounting year. In other words, these assets' usage and benefits to be derived from them elapse in more than a year. So that's why we call them non-current assets. The current assets are the assets whose economic benefits, service potential is within a year. Okay, so we sort of think their lifespan is within 12 months. And so that is why they come under current assets. And we can have inventories, receivables, prepaid expenses, and other cash in hand, cash at bank. All of those things will be regarded as current assets. So when we add non-current asset to the current asset, it gives us the total assets. Now, the accounting equation is such that total asset equals equity plus liability. Stay with me carefully. Total asset equals equity plus liability. So that is what we call the accounting equation. And you learned this in KG2 when you started learning accounting. Total asset equals equity plus liabilities. That is the same idea we are going to be using in the preparation of the statement of financial position, that your total asset should be equal to total equity and liabilities. In other words, when you prepare the statement of financial position and your total assets does not equate to your total equity and liabilities, then you are horrible monami somewhere. It means you made a mistake somewhere. In the exam hall, you just leave it and go away, because it is not now you are going to try to balance your balance sheet or balance your statement of financial position. But assets must be equal to capital or equity plus liability. Then under equity, as we said, the shareholders fund will be coming under the equity. Then the liability aspect, that one too will be splitted between current and non-current. Now, non-current liabilities are liabilities that are going to be paid in more than a year. But the current liabilities are the liabilities that are to be paid within the next 12 months. So that is also going to be presented in the financial statement, and we have them coming up. Then certainly we get total equity and liabilities, and that is all in respect of that. So that is the statement of financial position. Please, when we start working on the accounting standards, the IFRS masterclass, we are going to be extracting financial statement, but not a full financial statement. And so this walkthrough we are doing is for the grand scheme of the way you prepare the whole financial statement, but also dealing with that question 2 area, standalone standards, when we are supposed to present something in the financial statement. So now you know when we say something is supposed to be recorded in the P&L, something is supposed to be recorded in the OCI, something is supposed to be recorded, in the changes in equity, or something is a non-current liability, something is part of shareholders' fund, you know where exactly it's supposed to be. So when you're extracting the financial statement, you record it as such. So this is a crucial discussion to set you up throughout the discussion, especially when it comes to dealing with the accounting standards. But then we also have the cash flow statement, because at the end of the day, profitability is good, but the survival of the company depends on the cash flow. A company can record a profit, but if the cash flow of the company is negative, that company is going down. And so the cash flow statement is a statement that is prepared to reconcile the profit with the cash and cash equivalent. What does that mean? So for instance, during the year, the entity records a profit of $10 million. But then when we look at their cash and cash equivalent, meaning the money they have in hand and money they have in the bank, it is just negative $3 million. Stay with me. The company has recorded a profit of $10 million, but the cash and cash equivalent is negative $3 million. Where did the money go? Where did the profit go? Yeah. The average investor would think that profit is equal to cash flow, but profit is not cash flow. So the cash flow statement is then prepared to show us where the money went, how much money came in, categorized into operating activity, investing activity, financing activity. And that is a standard on its own, IAS 7. We'll talk about that later on as we proceed in the discussion. Then certainly notes to the financial statement. Yes. So when we talk about a set of financial statement, the notes to the financial statement is also important. And these are for disclosure purposes. Because at the end of the day, we must provide notes explaining the figures in the financial statement. Because you cannot just tell people that, during the year, we recorded an income tax of $42 million. How did you come up with the $42 million? So the workings, the breakdown of that income tax figure will be in the notes. Then any other information that will enhance the understanding and usefulness of the financial statement will also be provided in the notes to the financial statement. And these are the things that you must understand when we talk about the sets of financial statement to be prepared. Statement of profit or loss and other comprehensive income, statement of changes in equity, statement of financial position, the cash flow statement, and then the notes to the financial statement. Now, in between these guys, there are a number of other issues that may be part of the financial statement of the entity, but it depends on the entity. The first one is what is referred to as the value added statement. It is in your syllabus, so we're going to talk about it later. The examiner has brought a theory question on this in the past. Value added statement. Now, this statement tells the company how much value they have generated during the year and how that value can be distributed or allocated to the various key stakeholders of the entity. So sometimes value-added statements will be there. Then the last one is going to be a sustainability report, which we're going to be talking about later on when we get into environmental issues, talking about sustainability. So a sustainability report. So when you take financial statements of EcoBank, MTN, GCB, and these companies, you will realize that they have the P&L, they have the cash flow, they have the changes in equity, they have the notes to the financial statement, then they have sustainability report as well. Some of them may have even value added statement as well in respect of that. So these are other financial statements, or if these are other statements that may be part of the financial statement of a company, but it is not something that is regular. The regular guys that stakeholders expect to see are these first five: profit or loss, position, changes in equity, cash flow, and the notes. But if you paid attention to the discussion so far, you will realize that in each of these financial statements, we are mentioning some things: revenue, expenses, assets, liabilities, income. So if you pay attention, you realize that all the financial statements we've spoken about, you keep hearing that: assets, liabilities, expenses, revenue, income, equity. These are what we refer to as elements of the financial statements. So one-liner definition, let's look at them quickly. Now, you know this in KG2. Technically, I'm not supposed to teach this. Okay, technically, I'm not supposed to teach this because you know this from KG2. But, let's address them quickly. What are assets? I need a one-liner definition. Don't steal, okay? Don't steal. Just assets from your understanding. What is an asset? When we say the asset of a company, what is it? You learn this in KG2. Just come out with your natural understanding. Then, what is a liability? What is an expense? What is revenue? Is revenue the same as income? What is equity? Yes, one-liner definition. I'm not supposed to teach this really, but I have to do my work so that somebody will not come and say, hey, I'm new to accounting. I have never learned accounting before. You come to the class, Nhyira is saying that this thing, you know them already, then you jump and go away. What kind of class is this? I got you. Okay? I got you. So let's talk about it. So what are assets, liabilities, expenses? Give me one-liner definition. You can raise your hand, I bring you up, or you put it in the chat for me. Quickly, what am I having? Okay, I'm seeing a chat coming up. You can raise your hand, I bring you up as well if you want to speak. Assets are resources which is controlled by an entity for the running of their business. Yeah, that's perfect. So assets are resources controlled. The key word here is controlled. Okay? In KG2, you learned that assets are resources owned by the organization. That was what you learned. But at this level, as a professional accountant, the key word here is control. Why? Because the entity must not own it. So we can lease an asset and recognize that asset in our books in accordance with IFRS 16 leases. Legally, it's not ours, but we control it. Hence, it is our asset. So assets are resources controlled by the entity. Okay, what else we got? Liabilities. What are liabilities? What is an expense? Come on now, these are KG2 definition. You should be able to have them boom, and go away now. Eh? We shouldn't waste any time on these things. What's liability? Some of you are going to steal from ChatGPT. Can it be? So liability is a present obligation. Okay? A present obligation as a result of past event. So you are owing now because of something you did previously. A liability is a present obligation as a result of past event, the settlement of which will result into an outflow of future economic benefit embodying the entity. That is the flexing definition. But really, it's a present obligation as a result of past events. Revenue and income, are they the same? We use these interchangeably. Are they the same? Revenue and income, are they the same? They are all inflows of the entity. Okay? They are all economic benefit inflow of the entity. But are they the same? No. For the most part, revenue relates to the inflow of future economic benefits or the inflow of economic benefit from the core activities of the entity. Okay? From the core activities of the entity. Income, on the other hand, refers to the inflow from non-core activities of the entity. What does that mean? So if I go to a pharmacy to buy drugs, to buy something, now these days at a pharmacy shop, they sell all manner of things. They sell slippers, they sell bathroom towel, can it be fair in pharmacy shops? You don't know who came up with that. So now a pharmacy shop has turned into a mini mart, but we move. So let's say we go to a pharmacy shop and we buy a drug. What should we buy at a pharmacy shop? Maybe we buy whatever the heck. Whatever. So we buy a drug. Okay, let's say we buy baby diapers for baby Nhyira. So we buy baby diapers for baby Nhyira. Then we pay for that. That money is revenue to the pharmacy shop. But if the pharmacy shop has bought some shares, okay, the owners of the pharmacy, the company as an entity, owns some shares on the stock exchange and they pay them dividend, that's income. It's not revenue. Or maybe they own some offices, or the office that they have, they've rented some part out to other people. So rent income. Okay? That's it. Or they have some fixed deposit at the bank, or they bought some treasury bills and they are receiving interest on them. That's income. So that's the difference between revenue and income. And so this is where you have to be careful. When it comes to the day-to-day activity of the company, you are going to then be applying IFRS 15. Revenue from contract with customers. Revenue from contract with customers. Revenue from contract with customers. Because if it relates to the day-to-day running of the organization, we apply IFRS 15. But income, there are various other accounting standards that may be called on. As we mentioned earlier, we can call on IAS 40. We can call on IFRS 5. Non-current asset held for sale and discontinued operation. No, IFRS 9 rather. Let me put it there, IFRS 9. We can call on other accounting standards when it comes to the income area. So that's the difference between revenue and income. Sometimes they are used interchangeably, but that's the distinction. Other times in some industries, like in the financial institution or the finance sector, you may not see revenue, you will just see income and they go away, but they segregate it like income from operation, income from other sources. So you may not see revenue and income in some industry or sector's financial statement, but the distinction is always done there for you to know that the things that come from the day-to-day running of the organization, we apply IFRS 15. Other receipts that we have will be accounted for in accordance with other accounting standards. So that's the difference between income and revenue. What is an expense? What's an expense? An expense from KG2 is the cost of operation, right? The cost incurred in the running of the day-to-day activities of the entity. That's an expense. But you got to understand that reduction in income is also an expense. What does that mean? So we come to trade receivables. Somebody is owing us. Okay, trade receivables. So Eunice bought from me and Eunice has not paid me. and Eunice owes me $100,000. Okay. Then something happens and Eunice says, Nhyira, yeah, I owe you $100,000, but I cannot pay you the $100,000. If anything, you may get 30% of the $100,000. Uh-oh. It means I just lost $70,000. That $70,000 can be provision for bad debt or bad debt written off. That is a reduction in income. So it is an expense. Then the third one is increase in liabilities. Increase in liabilities is an expense. So, for instance, taxes. We pay taxes in arrears, and we'll talk about this in IAS 12 later as we proceed in the discussion. But we pay taxes 1 year in arrears. And so we thought that we owed the Ghana Revenue Authority $120,000 in taxes. So we made a provision for that in the last year. But GRA comes and says, uh-oh, you actually supposed to pay us $250,000. So we provided for 120, but we are now paying 250. That's an extra of 130,000. That is an expense. So increase in liability is an expense. Reduction in income is an expense. Now, the reverse of those two will be regarded also as income. So reduction in liability is an income. Increase in your receivables for some reason will be an income. So if I owe someone, okay, so say I owe Francis $120,000. Then Francis comes and say, oh, we are doing some promotion, right? And so, if you're able to pay us in the next 1 week, you get 20% discount. So discount received is an income. Discount received, cash discount received is an income. Why? Because it's a reduction in our liability. Same thing happens to the receivables. If someone owes us and there is our contract demands that after a number of period, if the person doesn't pay us, then we will charge the person a penalty. Then the penalty that we charge becomes what? An income that we are receiving. All of these are fundamental issues that you must understand, because when we get to the accounting standards, these things are going to be sneaking their heads back. So now you know, reduction in income is an expenses, because you thought you have 100,000, but now you can get only 30,000. So that 70,000 is au revoir mon ami. You have to write it off. It's an expenses. You thought you owe somebody 200,000, but for some reason you owe the person 300,000. That extra 100,000 is an increase in liability. It's an additional expenses, and the reverse of that is true. So that is the idea about assets, resources controlled, liability, present obligation as a result of past event, expense, cost of running the operations of the organization, reduction in income, increase in liabilities, revenue, inflow from the day-to-day running of the organization, income, inflow from non-core activities of the organization. Then the last one is equity. Equity is like shareholders' fund, as we mentioned. It is what is left when we subtract all our liabilities from our assets. That's all. And these are the elements of the financial statement. So everything we're going to be doing in financial reporting and corporate reporting relates to these elements. And the accounting standard will be helping us to address all of these issues in various shapes and forms. That's it. We are done. Those are the elements of the financial statement. So we've seen the objectives of the various financial statements, the elements or the pro forma of the financial statement, then the elements of the various financial statements that we prepare. The next question we need to ask ourselves is, who are the users of these financial statements? It's part of your theories. You learned this in KG2. So again, it's an area that you have to be mindful of. Users of financial statements. The play here is that you need to be able to list the users, but most importantly, they are information need. In other words, why would they be interested in the financial statement of the entity? So you must know at least 5 of these to position you as you go into the exam hall. Okay, at least 5 of these to position you as you go into the exam hall. Number 1 is management. Management need the financial statement of the entity for policy assessment, internal controls, and strategic decision making. That's it. So that if they realize that our operating expenses are more than our revenue, what do? Is there a way we can reduce the expenses or increase the top line item, our revenue as an entity? Can we do that? Okay, if we can, let's do it. That's the idea there. 2, employees. Why are you interested? You have to be interested in the financial statement of your company, the company you are working for, if you're an employee. Job security, because you have to be assured that the company will be there. Okay, so if they are running the company into the grounds and you just sit there and you don't do anything and you don't look for another job or you don't do something quickly, you will be unemployed very soon, because if the company goes down, you become unemployed. Job security. For instance, you saw the banking sector cleanup exercise, where after that situation, some people of these companies turn out to now become to do other menial jobs, right? That they didn't know, they didn't even think they were doing. So the question is, do you check your company's financial statement? Because you may think you have a job. Because of that, you have gone to marry. Because of that, you've gone to take a mortgage on your house. Because of that, you've taken car loan to buy a new car. Because of that, you are walking around by heart doing kokoti. Before you know, the financial statement of the company has become au revoir mon ami, and you are out of job. Then you lose the house, you lose the car, you lose your kokoti life, then you become humble. So employees are interested in the financial statement of the company for job security. Also for performance evaluation, and most importantly, salary negotiation. This is where the deal is. Because people are like, hey, look at this company. It's recording enough revenue and they are paying us miserable salary. You are looking at the revenue. Did you check the profit? And recently, I had an encounter with somebody on X like that, where a young lady posted and say that the private companies in this country are wicked companies because, they pay people menial amount of money and they demand them to do the job and they sell their houses in dollars. And I'm like, that's one of the dumbest things you can say in your entire life if you say a company has to pay you more because they sell their houses in dollars. It's very dumb because you are looking at the top line. Have you looked at the profit? Have you looked at return to shareholders? Have you looked at taxes? Have you looked at operating expenses? Have you looked at the value you are adding to the company? So you got to be interested in the finances so that you can negotiate salary. You can negotiate your terms of employment pretty well at the end of the day. Next one, customers. Pretty important. If you buy from a company, you should be interested in their finances. Because who knows? They have to be there so you can continue to buy from them. Your goods. Suppliers and creditors, so that they can assess the liquidity of the company and be assured that if they sell to the company can pay them in record time. The government is interested in companies for quite a number of things. Maybe compliance issues as well as taxes. Right? GRA, taxes at the end of the day. Shareholders, the returns on their investment, whether their wealth is being maximized, and whether they can continue to be with the company, okay, or they should sell their shares. Shareholders, you look at the performance of the company and you make your decision. Then the community at large, assessing the capacity of the company to undertake corporate social responsibility. And so that is where sometimes you will hear a community come out and say, this company is in this community. They are making a lot of money, but look at our roads. They have not done anything in our community. Yeah, because they feel the company is making a lot of money, but the company is not giving anything back. So these are some of the users of financial statements, information, and most importantly, how that is going to be used by each of them to make various decisions. Okay? So from today, if you're an employee, every year be interested in the company you are working for, their financial statement. Okay? So that they don't catch you by surprise. You'll be there, no, they send you letter. Because you see, companies don't just get up and lay off people. The layoff should start when the financial statement starts smelling. So quickly, if you track your company where you work for, when the financial statement starts smelling, then you got to find out that your job is not secured. You got to look somewhere else quickly. Otherwise, you'll be there, no, they gave you a letter. You two, you have just done your wedding and you have bought a new car. You've taken a mortgage to buy a new house. Then you lose your job. Then come and say that it's not fair. It's not fair. Your face. Why didn't you read the financial statement? So those are the things that we must understand there. Francis is saying, please, is loan at times be treated as revenue? Loan? No. Loan is not revenue to the company. Okay? In the public sector environment, because Francis, you are doing public sector, in the public sector to the government, loan is a revenue. So in the public sector environment, loan is part of revenue. But in our private setting environment, financial reporting, loan is not revenue. Loan is a liability. Do you get the idea? Because you have to pay it back. Do you get the idea? Revenue, you worked for somebody and the person is satisfied and they give you the money. That's revenue. But loan can never be treated as revenue. It is a liability. Loan forgiveness, like the example I gave earlier, right? You owe someone and the person says, oh, I could see that your company is struggling. We will slash 30% of how much you owe us so that you can restructure yourself. That is income. Do you get the idea? So the loan forgiveness will be income. Cannot be revenue. Okay? Cannot be revenue. Ruth Kessie, why are you watching on YouTube when meeting link was sent to you? Hey, we are seeing who? Meeting link was sent to you, but you are watching on somewhere else. You are watching from somewhere else. Hey, Sister Ruth Kessie, yo. Okay, so that's the users of the financial statement. Okay, now let's bring the discussion home. We have seen the financial statement. We've seen the elements of the financial statement. We've seen the users of the financial statement. But does it mean any financial statement at all will really be useful to the users that we've spoken about? No. Okay? No. No, generally. No, Ruth, not, there is another Ruth. Ruth, I hear bled, not you. There's another Ruth that I'm talking about. You are here on Microsoft Teams, so no problem. There's another Ruth that I have seen somewhere that I'm talking about. She's also supposed to be on the call, though. But she's not there, so that's why. So what makes a set of financial statements useful to the users? For a set of financial statements to be useful for the users, it must have a set of attributes. The set of attributes that a financial statement must have to be useful to users is what we refer to as the qualitative characteristics of financial statement. And you learned this in KG2 as well. Okay, I'm not supposed to teach you this one. Qualitative characteristics of financial statement. Faithful representation, timeliness, It's a 5-mark question. That everything I'm discussing are those theory issues the examiner can bring to you. That's what I'm talking about it. It's not like, I am doing some freestyle, Kpako. If I finish the freestyle, then Kpako, we're going to start with the syllabus. No. Everything I've spoken about are examinable questions which the examiner has even asked in the past. Okay? So these are all topical areas that you have to be mindful of. So qualitative characteristics of financial statements. As we mentioned, these are a set of attributes that financial statements must have to be useful. So let me take you back into the book. Qualitative characteristics of financial statements. So in the book, page 13 of the book, because I said I'm presenting myself in that manner. So we have what we call faithful representation. Okay? Faithful representation simply means that the information must be faithfully represented or must represent the economic and other phenomenon of the entity. In other words, for us to say the financial statement has been faithfully represented, there are 3 things that must be present. 1, the financial statement must be complete. Now, you got to be careful because completeness means 2 things here. Completeness means all transactions that occur during the year, within the accounting year ended under review, have been recorded. Then another layer of completeness also means that, like, we have the set of financial statements. In other words, if a company prepares only P&L and position, users cannot rely on only these 2 and make any meaningful decision about the company. So we need P&L, we need position, we need changes in equity, we need cash flow, we need the notes to the financial statement. That is the complete financial statement. Second, for the financial statement to be faithfully represented, it has to be neutral, meaning that it should be free from bias, because there are a lot of professional judgments we're going to be exercising in the preparation and presentation of financial statement. And we'll come back to this later on under ethics. So when we are exercising the professional judgment, we need to be, it has to be free from bias. So for instance, let me give you a freestyle here. Remember I spoke to you earlier about the receivables. Where is it? The receivables, right? That Eunice owes me 100,000. And Eunice says, Nhyira, I cannot pay you. So I'm going to pay you only 30,000. Okay. If I write the 70,000 off, that's an expenses. That means our profit for the year will be reduced by 70,000. Then our statement of financial position, our asset base, will also be reduced by 70,000. So although Eunice has indicated that Nhyira, I cannot pay you the 100,000 because I am financially down and our company is winding up, I may still keep the 100,000 in the books. Why? So that my profit will be huge. So management, we can make more profit and get our bonus for the year. Then the financial position also will be encouraging because our liquidity position will be better. Our asset base will be better. When I do that, I am being biased. It means the financial statement is not faithfully represented. I hope you are getting the thought process here. So that's why we are saying here that it must be free from bias. It means you prepare the financial statement with an open, clean, honest mind. And this is where ethics comes to town, which we will get into in a moment. Then the third thing is it should be free from material errors. Yeah, errors are allowable, but material errors should not be entertained. And nothing that we cannot allow a newly qualified accountant to come and prepare the financial statement of the company. And Nuntina, we cannot allow somebody holding MBA to be the chief accountant of the company, preparing the financial statement of the company. Why? Because 99.9% of the time, the person holding an MBA in accounting and finance has no clue on how financial statements are going to be prepared. Why? Because the depth of accounting standard transactions treatment that is required to prepare financial statements for a company are not discussed in the MBA class. So, financial statement must be free from material error. That's the concept of faithful representation. It should be complete. It should be free from bias. It should be free from material error. The second qualitative characteristics is relevance. In other words, whatever information that is material, necessary for that may impact the decision-making capabilities of the users must be disclosed or recognized in the financial statement. That's the concept of relevance. So pay attention again. Come back to Eunice's example that we used earlier. Eunice has already disclosed to us that her business is winding up. She owes us 100,000, but she can only pay 30,000. If we keep the 100,000 still in the book, that means we are misleading the users of the financial statement. Because everybody will be thinking that, oh, our receivables is 100,000, when in reality, it is just around 30,000. So the disclosure of that in the notes and the appropriate adjustment of same in the P&L and position is relevant for decision-making capabilities of the users. That's the concept of relevant. So whatever information that may influence the economic decision-making capabilities of the users must be available. Then we come to so these two are what we call fundamental qualitative characteristics. All right. So I use this example, just to explain it that, it sets, these are the pillars holding it, but we cannot just use that to say, okay, once we have relevance and then faithful representation, the financial statement is yai. No. We need some other characteristics or attributes to be present to really embellish the financial statement and make it perfect. And so those other qualitative characteristics include timeliness, understandability, issues about comparability, and then verifiability. So let me bring up comparability. You see, the financial statement should be prepared in such a manner that it will be comparable. What does that mean? It means that we should be able to compare this year's financial statement to last year's financial statement for performance evaluation. But comparability of financial statement can only be possible when there is consistent application in the accounting policies. And we'll come back to this under IAS 8, accounting policies, changes in accounting estimates, and errors. Because comparability is only possible if we use the same basis of accounting policies in the preparation and presentation of the financial statement. Timeliness, on the other hand, simply means that the set of financial statements should be provided when needed to influence decision making. In other words, when the financial statements are too early or late after the decisions are made, then the financial statement will lose their value. So it should be provided within the time required to aid users to make informed decisions. Verifiability simply means that the financial statement should be prepared in such a manner that independent observers will reach similar conclusion. In other words, when auditors come, they should be able to look at the financial statement and reach a conclusion and say, oh, okay, the financial statement represents the true and fair view of the entity. In other words, everything is okay at the end of the day. Then the last one is understandability. Financial statement must be presented in a manner that will be clearly understood by users of the financial statement. That is why if you look at a pro forma, revenue is there, cost of sales. Very simple. So the average investor, the average individual can have an understanding of what is going on in the financial statement of the entity. These are what we refer to as the qualitative characteristics of the financial statement. It's a 3 to 5 mark question that the examiner can holler at you in the exam hall. It's not difficult, is it? It's not difficult. Easy peasy. Any other questions? You raise your hand, we'll bring you up, or you put it in the chat for me. Okay. Finally, it is important we understand that everything we're going to be doing, there are some assumptions that we are going to be applying as the conceptual framework guides us. And so we come to the final area of our discussion, and these are the accounting assumptions that underline the preparation and presentation of financial statements. The accounting assumptions that underline the preparation and presentation of financial statements. For the most part, financial statement must be prepared on a going concern basis. What does that mean? It means that going concern simply means the entity is seen to be able to operate within the next 12 months. Stay with me. In KG2, you learned that going concern means the entity can operate into the foreseeable future. That was KG2 definition. At this level, assessment of going concern is simply asking the question, can the entity operate and be in existence within the next 12 months? If the answer is yes, then the financial statement will be prepared on a going concern basis. If the answer is no, then the financial statement will be prepared on a breakup basis, meaning we are winding up. We close shop and we go away. So that is going concern. The second is the accrual basis, okay, which is going to be a fundamental issue where revenue is recognized not when cash is received, but when performance obligation is satisfied, IFRS 15. Expenses is recognized not when cash is paid, but when the transaction takes place. That's the accrual basis. So everything we're going to be doing will be based on the accrual basis. It is only in the cash flow statement preparation that we'll be dealing with cash basis. But in the preparation of P&L, statement of changes in equity, the statement of financial position, we're going to be using the accrual basis of accounting, where it is not about cash, but it's about have we satisfied performance obligation, then revenue. Have we enjoyed the service potential from the transaction, then expenses would have to be recognized. But when we get to cash flow statement preparation, that one, we will be using the cash basis of accounting. And that is IAS 7. We'll get into that later. Then the last one is substance over form. Now, the concept of substance over form is simply recording the economic phenomenon of a transaction over its legal form. Stay with me. The economic phenomenon of a transaction over its legal form. Remember the definition of asset we gave earlier from Francis, that assets are resources controlled, and I told you about leases. Now, when we lease an asset, legally, the asset is not ours, is it? No. It's not ours. So, per the laws, since the asset is not ours, then you can't put it in your books. But from the accounting class, we control the asset. We direct the usage of the asset. We depreciate the asset. We maintain the asset. We control how the asset is to be used. So from an economic point of view, the asset is ours. And we will recognize it in our books. That's one aspect of substance over form, recording the economic phenomenon of a transaction over its legal form. Same idea about IAS 24, which we will come to later, related party transactions. Now, related parties can be, related party transactions are transactions that occurs between the company and key management personnel, the company and the relatives, close relatives of the key management personnel, or when two companies have the same shareholders or the same control, similarly controlled by the same people, then they are related parties. During the year, there may not be any transaction between them. But once they are related party transactions, we must disclose it in the notes. Then transaction between the related parties must be at arm's length. And you will see more of this in advanced taxation or in principles of taxation. If you are going to do taxation later in your journey, you're going to be seeing that later, where transactions between related parties must be at arm's length, which means that if I have, so let's say that I have Nhyira here, then I have Kukua here, then I have Adepa here, right? And let's say Kukua is Nhyira's wife, Adepa is Nhyira's sister, okay? Just an example. It means that the transaction occurring between Nhyira's company and Kukua company will be a related party transaction. Now, even if during the year no transaction occurs between them, we must still disclose this in the notes. Now, whatever transaction occurring between them must be at arm's length. What does that mean? So let's say Nhyira sold something to another person who is not related, Christopher. Okay? And Nhyira sold that thing to Christopher for $20,000. But when Nhyira was selling the same thing to Kukua, his wife, he sold it at $35,000. The same thing. No? What is happening here? Now, in financial reporting, we are not going to be dealing with this. This is in taxation, but I want you to understand the concept of related party. So it means something is going on here. Why is Nhyira selling the same thing to Christopher at $20,000, but selling it to Kukua at $35,000? It could be a tax planning arrangement where the Nhyira is arranging that to ensure that the family income and the family tax is less at the end of the day. And you're going to be understanding this later on in taxation. But what we are saying here is that transaction between related parties must be at arm's length. And if they are not, then the transaction must be reversed at the end of the day. But whatever transaction occurring between related parties must be disclosed in the books. And we record the economic phenomenon of the transaction over the legal form of the transaction. These are the three concepts you must understand about financial reporting and preparation of financial statement. Now, there are other concepts that you learned in KG2, business entity concept, money measurement concept, those guys, realization concept, those kinds of things. You learn those things as well. But we are really going to be getting excited about these three at this level when it comes to our discussion here. Any questions? You raise your hand and we'll bring you up, or you put it in the chat for me. I remember I said finally, but finally now, okay? I'm coming to finally. The final area we need to look at is measurement basis. Please, if you will forget anything I have said so far, I can pardon you. It's unpardonable, but I can forgive you. But don't forget what I'm going into, because this is going to hold you up in the whole syllabus. measurement basis. Because the elements in the financial statement that we've discussed, assets, expense, liabilities, income, equity, revenue, there are measurement bases that we use to measure them. And so let's look at the various measurement bases quickly. I'm going to come in from the book quickly on page 18 of the book. Page 18. Measurement bases. Oh, should I pull up on PowerPoint? Right. Okay, you let me go in this. There are two things you must understand as an accounting student: recognition and measurement. And we are going to be using this a lot. Under every accounting standard, you're going to hear initial measurement, subsequent measurement. Then you're going to hear recognize, recognition. So what is the difference between measurement and recognition? Simple. Measurement refers to the determination of the monetary value of a transaction. In other words, the value at which a certain transaction should be carried in the financial statement. That is measurement. Recognition refers to the incorporation of the transaction in the books of the entity. We will get into this more, but let me give you just a freestyle. So under IAS 16, we say that the initial measurement of an asset shall be the purchases cost plus all other directly attributable costs incurred in bringing the assets to its present use. So that is the measurement of PPE. After that measurement, we then have to recognize it in the books. And that is where we will say that the initial recognition will be to debit property, plant, and equipment and possibly credit cash. That is recognition. You good? So how much, at what value should we carry the item? Measurement. How do we record the item in the financial statement? Recognition. Very important. And so the question we then have to ask ourselves is, what are the various measurement bases? The first one is the historical cost. The historical cost simply is where assets is recorded at the fair value of the consideration given to acquire them at the time of their acquisition. So remember what I said earlier in the freestyle for IAS 16, that the initial measurement of an asset shall be the purchases cost plus all other directly attributable costs incurred in bringing the asset to its present use. So let's say that we buy an asset for our business. Let's say we buy a new camera for whatever, let's say $15,000. Okay. That's how much we paid for the camera. Shipping, okay, because it's coming from the US. Let's say we pay shipping for $100. Then let's say handling and getting it home. Let's say that is another $200. So in total, by the time the camera gets to our office for us to start using it, we have spent $15,300. Right? That is the historical cost of the camera. That's the first thing we must understand. The historical cost. The amount of money we paid to acquire the asset, to bring the asset to its present use. That is the historical cost. That's the idea. Next one is current cost. Stay with me. The current cost has two things. We have what we call the reproduction cost and replacement cost. What you are really going to be getting excited about will be replacement cost. Replacement cost is the most economic current cost of replacing an existing asset with an asset of equivalent productive capacity or service potential. So that is the replacement cost. In other words, let's say that we bought this camera 3 years ago. So we've been using this camera for 3 years. The money we paid for it 3 years ago, the $17,300, is the historical cost. Now that the camera is 3 years old, if we want a 3-year-old camera of that same specs, maybe Sony FX30 or something like that, of that same specs with a G Master lens on it, of that same spec, 3 years old, how much will it cost us now? That is the replacement cost. So 3 years ago, how much did we pay? $17,500 historical cost. Today, if we want to buy a 3-year-old camera like what we have, how much do we have to pay? That is the replacement cost. Then we come to net realizable value. And you're going to see more of these under the standards as we proceed from next week. The net realizable value is what we get if we sell the asset today. So the camera that we bought 3 years ago for $17,300 historical cost, if we are selling it today, how much will we get? That's the net realizable value. So the net realizable value is the fair value less cost to sell. Stay with me. So let's say that today we can sell the camera for $9,000, but we have to list it on maybe one of these shops, Gigi, okay? Or maybe pay a sales agent a commission. So the commission for the sales agent should be 10%, so $900. And so in total, we can get $8,100. That becomes the net realizable value. The fair value less cost to sell. You're going to call on this in IAS 36, impairment of assets, later. Next one is value in use. Stay with me. You're going to call on this also in impairment. Value in use is simply the future economic benefits, the future cash flows expected to be generated from the asset from continuous usage. So let's tidy the discussion up. I want you to follow me carefully. 3 years ago, how much did we pay for the camera? $17,300. That is the historical cost. Today, if we want a similar camera, 3 years old, with the same specs, how much will we have to pay? That is the replacement cost. This camera that we've been using for the past 3 years, if we sell it today, how much can we get? That is the net realizable value. If we don't sell this camera today, it still have 5 years to go. Okay, we can still use it for 5 years. So for the next 5 years, how much cash flows do we expect to generate from the camera? That is the value in use. And so because it is money we expect to generate from the continuous usage of the camera over its remaining economic life, we are going to be discounting that into present value. That's value in use. Easy peasy. Then the final thing is fair value. And we'll come back to this also under IFRS 13, fair value. Fair value is simply the value at which an asset can be exchanged or a liability settled in an arm's length transaction. So you realize what I mentioned earlier about the camera in terms of its fair value. And I said that we will sell it for $9,000. That's the fair value, because that is how much someone is willing to pay for the camera in an open market. These are what we mean by measurement basis. And throughout the discussion, you are going to be hearing them over and over and over again. Historical cost, replacement cost, net realizable value, value in use, fair value. We also have present value, but I've put it in the value in use concept for you in respect of that. Any questions for me? Any questions? I'm seeing a chat coming up here. Please, can you break down the initial measurement and subsequent measurement in Fante? Look at this guy. How do you expect me to speak Fante in class? Bro, are you going to be writing Fante in the exam hall? Miss it. Initial measurement, no? Yeah. Sika etia say, hey, go with you. We'll talk about initial measurement and subsequent measurement from next week when we start the accounting standard. Okay, so when we get there, you will get the understanding. Like I said, for instance, we are buying the camera, right? It cost $15,000. We pay for shipping $100. We paid for handling $300. So in total, by the time the camera is ready for us to start using it for video production, we spent $17,300. That is the initial measurement. In other words, we will recognize the camera at $17,300 in our books. That's the idea in respect of that. Okay? That's the idea. And we'll come back to this later on in IAS 16 and you will understand it more. But the fancy, that one there, I can't do that. You can't tell me, can't ask me to teach IFRS in Fanti. Come on, that's punishment to me. That's punishment to me. Abraham said, please, mentor, how much is the book and how do we, those in the north, get it delivered to us? I don't know if you're doing FR or CR, but FR is $240. You can send a message on WhatsApp. My assistant will help you. Delivery will be done. If you are in the north, I don't know which part of the north you are at, but delivery can be done for you and you can get it once the book is available. Okay, that is from Abraham. Yeah, so Abraham, you can send a message on WhatsApp. My assistant will help you to make payment, and when it's available, delivery will be done for you wherever you are located. Okay, but it's 240 cedis. 240. Okay, so that is what you must understand when we talk about conceptual framework. I'm done. And that is my introduction to financial reporting. Here is your assignment number 1. It's a reading assignment, okay? You are going to read on Redo. Come here next week and you have not read. You see what I'll do to you. The IFRS Foundation. Those of you with the book, IFRS Foundation, page 21. This is an important area that the examiner can bring in that question 5 area as a theory question. He has done that in a number of examination diets in the past, so you got to be mindful of that. This tells you how accounting standards are set, the stages involved, the procedures involved, the various committees involved. So please read this, okay, ahead of me. That's your reading assignment for today, okay? Reading assignment. Some of you don't like reading. Read it, okay? Click record on your phone, and then read, record your own voice. Then you can be listening to it over and over and over and over again. But that's your reading assignment for today. And that is what you must understand about the conceptual framework. So the examiner can throw between 5 to 8 marks question coming in from here that you must understand. And it can be about measurement of an item. It could be about the qualitative characteristics. It could be about the definition of the elements of the financial statement. Yeah. The definition of the elements of the financial statement and how they are recognized in the financial statement based on the pro forma of the financial statement that we have spoken about. But as we mentioned, you remember that when we're talking about the qualitative characteristics of financial statement, especially under the fundamental qualitative characteristics, relevance, and faithful representation, we kept talking about the behavior of the preparers of the financial statement. And that leads us to ethics. And that was a 10 marks question that the examiner brought last semester, financial reporting. ethics. But before then, we're going to take a short breather, come back refreshed, get ourselves excited into ethical issues, and solve some questions and see how far we can go. Okay, so we're back, we're back, we're back, we're back, we're back, we're back. Let's go, let's go, let's go, let's go, let's go, let's go. Let's go. some of you, some of you are just crazy. Listen to somebody. Somebody said, can you Ruti said, please, can you explain value in use in Chinese for me? Francis was asking for panty. I couldn't even do panty. Na Chinese na made to me. I mention Chinese. Eh? What's the name in Chinese? What do you mean I call Chinese school? And I mean cultural Chinese. All right, so let's go. Ethics. Ethics. Don't find any device. Ethical issues, quite important area for us. As I showed you last semester, 10 marks question in the exam hall that examiner brought. And it's one of the theoretical issues that we need to be mindful of. So we're going to run through that as we continue in the discussion. Ethics is simply the concept of an expected standard behavior of a group of people. That's it. Morally, what you are doing to be right at the end of the day. And as professional accountants, you are required to be of a good behavior. In other words, be ethical in everything you do. You cannot just do things anyhow, but you got to be ethical. And so there are the ICAG Code of Ethics, and sometimes refers to as the IFAG Code of Ethics as well, because ICAG is a member of IFAG, which is the International Federation for Accountants. And so ICAG is a member, so ICAG has adopted that, and so it becomes the ICAG Code of Ethics. And so as professional accountants, now this is cutting across whether you are a student, you are an associate, or you are a member, or a fellow, or whatever, you got to be of a good behavior. So ethics. And so the behavior of the professional accountant is guided by 5 key themes that we need to be mindful of. So this is coming from the book. In the book, ethics will be, give me a sec, because I'm going to do the book and a PowerPoint presentation as well here, because I want a visual presentation to make sure that I'm getting your attention very well. If you can pay attention to the way I'm presenting. Page 27 of the book. Okay, so ethics, page 27 of the book. There we go. But I can take you down a little bit to page 30 for the one-liner. So ethics are a set of moral principles to guide human behavior. A set of moral principles to guide human behavior. A set of moral principles to guide human behavior. That is what I mean by ethics. Easy peasy. So what are these moral principles that must guide the behavior of professional accountants? Let's go through them quickly. The first one is the principle of integrity. Integrity. What is it? Simple. Integrity simply means to be honest and straightforward in all professional dealings and business relationship. So as a professional accountant, you must be honest and straightforward in all professional dealings and business relationship. Okay. Honest and straightforward to whom? To your company, to shareholders, to management, to other stakeholders like the Revenue Authority, GRA, and others. You must be honest. What does this mean? What does it mean to say the professional accountant should be honest in all professional dealing? It simply means that The professional accountant, so honesty entails accurate and faithful reporting of an organization's adherence to management system standards, while also being forthright about any potential conflict of interest. What does this mean in principle? So, as I said, I'm going to be moving in between so you get me well here. It simply means that a professional accountant should not be seen to be associated with misleading financial statements. Like the example I gave you earlier about Eunice owing me $100,000 and she says she can't pay $70,000, then I know that if I should record the 70,000 as expenses, bad debt, then our profit will fall by 70,000. Our asset base will also fall by 70,000. If I know that is what Eunice told me, and we cannot get the money, then the financial statement I have presented is misleading. So the profit has been overstated by 70,000. Our asset base has been overstated by 70,000 because that 70,000 is not coming. Honesty means the professional accountant must not be associated with any financial statement that is misleading. Honesty also means, or integrity also means, that the professional accountant must be seen to be the one protecting public interest. Now, this is an interesting one because the word public interest is not defined really anywhere. So let me give you an example. Let's say that your company is looking for a loan. So let's bring in some numbers here. So let's say that Abraham is the accountant of the company, and Abraham is going to borrow money from Ruth Financial Institution. So Abraham is the accountant of the company. And then we have the CEO here. Let's say that the CEO is going to be Emanuela. So Emanuela is the CEO. So Emanuela is negotiating with Ruth about the loan. And Abraham was also there. Then Emanuela promised Ruth that, Abraham will bring the financial statement for them for the loan. Then Abraham prepares the financial statement. But there are a couple of things that Abraham did right. But Emanuela says, hey, I want you to prepare this financial statement this way. So revenues are recognized when contracts are signed. Provision for bad debts, they don't do it. They have revalued the assets and there is a significant revaluation surplus. So now your CEO, Emanuela, is telling you to misapply IFRS 15 because revenue is recognized not when we sign contract, but when a performance obligation has been satisfied. You don't just get up and revalue assets. There has to be systems in place to accurately value assets. So everything Emanuela is telling Abraham to do is in Semunu. It's misleading. Now, here is the case. If Abraham keeps quiet because he wants to keep his job, which is objectivity, we'll come to that in a moment, he wants to keep his job, and present that misleading financial statement to Ruth Financial Institution, and they gave the loan to the company, and the company is unable to pay, Ruth Financial Institution will sue the company, will sue the CEO, Emanuela, and will sue Abraham as well. Why? Because it is seen that Abraham should have known that the financial statement will be used to give a loan. So if the financial statements are fraudulently presented, then we are taking depositors' money and giving to you, so you are misleading the public. So you break public trust, Abraham, because you associated yourself with a misleading financial statement. So what if you are presented with this issue? Emanuela says, cook the financial statement. Window dressing, creative accounting, cook the financial statement. What do? You have to insist and say, Mom, I ain't cooking anything. Eh? The question is, can you look your CEO in the eyes and tell your CEO, Emanuela, I'm sorry, I'm not cooking. Can you do that? You're not going to do it now because you're going to lose your job. But the rule says, stand on your feet. Don't allow yourself to be associated with misleading financial statements. What if you lose your job? God will take care of you. That is the principle of integrity. You got to be honest. Got to be straightforward in all professional dealings. The question is this: in your dealings, are you honest? Are you straightforward? Or you keep cooking financial statements? One day we will catch you. If we catch you, Insawam cannot contain you. Your certificate will be revoked. And you have problem. And these are some of the things that caused the ICAG to find those accounting firms and the auditors who were involved in the banking sector cleanup exercise. Because some of the financial institutions were cooking the financial statements, and it was expected that auditors must know that, must see that. But for some reason, they said they didn't see. If the banking sector cleanup and the rot had happened in China or Russia, people by this time would have been hanging in the sky. But it's Ghana, so it's the first time. So that's why they were fined. That's all. But that is the principle of integrity. In all your dealings, be honest and be straightforward. If a situation presents itself which will impair your ability to be honest and straightforward, you got to advise yourself and insist the right thing being done. So that's the first thing, integrity. The second issue is objectivity. Remember I said something earlier about faithful representation, that the financial statement should be free from bias. As professional accountants, we are going to be exercising various professional judgments. A lot of professional judgment. Okay? I mean, the provision for bad debts we can make, the bad debts that we can write off in the books, how we will revalue assets, the value at which assets and liabilities must be carried in the books, how things must be recognized. Sometimes things could be capitalized, other times they must be written off. So instead of writing off the thing, the entity may decide to capitalize it. So we will be exercising various professional judgment. Objectivity means that in the exercise of professional judgment, as a professional accountant, do not allow bias, conflict of interest, and undue influence to impair your professional judgment. That's objectivity. So there are three things here. What is bias? Bias is where you favor the interest of a group of stakeholders over the others. So, I'm preparing financial statements. There is a debtor who owes us 100,000, but the debtor has indicated that we can only get 30,000. But I will not write it down, because if I write it down, our profit will not be up to be able to get our end of year bonus as management. Then our financial statement or financial position will not also be healthy for us to probably meet our loan gearing position. So what do? Cook the financial statement. So we are now being biased. We are favoring our bonus at the expense of the interest of the shareholders. That is bias. Conflict of interest is where you allow your benefit, what you will get, to override the objective of the financial statement. So remember the first example we gave about Emanuela and Abraham. Emanuela says, hey, we need to get this loan because your promotion is on the line, your salary is on the line, your job is on the line. So Abraham will say, oh, then let's get into the kitchen and let's cook. That is Abraham prioritizing his personal interest above the interest or the objective of preparing financial statements that faithfully represent the entity. That's conflict of interest. So in all your dealings, you must not allow your personal gain, your benefit to override the objective of the entity. Then the last one is undue influence. Undue influence is an indirect pressure put on the accountant to cause the accountant to do something that they will contrary not do. So here is the play. Emanuela, the CEO, tells Abraham, the accountant, that, hey, we need to get a job. We need to get a loan from Ruth. If not, we have to lay off 100 people. That's undue influence. That's undue influence. Now, Abraham has to sit down. Do I stand and say, I'm a man of integrity? I'm a man of my word. I will not stand here for you to prepare to present misleading financial statement to the bank. Okay, it means the company will not get the loan. If the company doesn't get the loan and these 100 people are laid off, Abraham, can you sleep? Abraham, will you be proud of yourself? Abraham, will you be comfortable? That's undue influence. Now, so you realize that everything I'm talking about are also coming in from the threats, things that will make the accountant to do a wrong thing. But we are saying that it doesn't matter. If Emanuela says they will lay off 100 people if the loan doesn't come, Abraham, you don't cook the financial statement. If we don't get the loan and the 100 people are laid off, they should be laid off. That's not your concern. But the question is, can you sleep in the night? When you drive past any of these people, knowing that your pious life, your holiko, your thou art righteous lifestyle has caused 100 people to lose their job, when you could have done some small cooking in the financial statement and their job would have been protected. This is what we are saying. No cooking in the financial statement. No threat. No personal gain. No prioritization of other stakeholders' interests above the others. Stand your grounds and remain and do what must be done. That's the concept of objectivity. So the question we then ask ourselves is, can you be honest and straightforward in all professional dealings? When you are exercising professional judgment in the preparation and presentation of financial statement, will you let your personal gains, undue influence, override your job, or you will make sure you do the right thing? A lot of you have been cooking a lot. The day your cup will be full, the cooking will over you. So from today, you got to stop cooking. What if I lose my job? Your wife will take care of you. Your husband will take care of you. And God is your keeper. That's the second thing, objectivity. Okay? Do not allow bias, conflict of interest, or undue influence to influence professional judgment. Number 3 is going to be the issue about professional competence and due care. Please stay with me professional competence and due care. It's two things here. Professional competence is about possessing the requisite skills, experience, and expertise required of the task. Due care, on the other hand, refers to carrying out the task in the manner that is expected. That's professional competence and due care. So it refers to maintaining professional knowledge and skills at the level required to ensure that clients or employers receive competent professional services and acting diligently in accordance with applicable technical and professional standards. So that is why you are learning. But the fact that you are an accountant now, or you become a chartered accountant, does not mean you can start preparing financial statements. Because you need to have the required level of skills, experience to be able to do the job. That is professional competence and due care. So now you are learning. Even if you become a chartered accountant, you have to continue to study. That is continuous professional development, CPD, right? Where you can attend a master class on, say, IFRS 9, and you are paying like 5,000 Ghana cedis, okay, for a 6-hour class. On IFRS 9, 5,000 Ghana cedis. Oh, but I did IFRS 9 in my course. Why should I go and pay 5,000? Your face. Because they will teach you something that you didn't learn during the class. Okay, because there are master class like that available where you are focusing on just a specific standard in a specific industry, and 6 hours, 5,000, some 15,000 and co. you are attending. It's all part of continuous professional development. Why do you need that? So that you'll be up to date. You have the skills required to be able to do your job as an accountant. That's professional competence and due care. And now you have to learn well. Do you understand? You have to study. You have to know the standards. You have to understand the financial statement. You need to be strong in the standards. Jenny, you become a chartered accountant, but there is nothing in your head. Bako, you are struggling. You have the certificate, but there is nothing in your head. Competence and due care. Then we go to the fourth one, and that is going to be my favorite one. That is confidentiality. Listen, professional accountants must learn to zip their lips. In other words, you don't talk by heart. That's confidentiality. Because you see, as a professional accountant, you're going to have access to a lot of information. Some of you are working in the finance department and you literally know everything. How much the board chairman is earning, the CEO, their plane tickets, when they travel for an executive training program, the hotels, the expenditure. You see everything. But you don't say it. Confidentiality. So confidentiality simply means that respecting the confidentiality of information acquired as a result of professional and business relationship and not disclosing any such information to third parties without proper and specific authority, unless there is a legal or professional right or duty to disclose it. So you got to keep quiet. Sometimes the girls, you go to the salon, right? And I say this always, like you go to the salon. And at the salon, that is where you hear people talking about sensitive corporate business things at the salon. This company that I'm working for, the CEO, where is confidentiality? Or you reach home, your wife prepares a meal for you, finish eating. Honey, how was your day? You say, today? Oh, God has to bless us. Today? Can you imagine today we're in the board meeting, and in the board meeting, the CEO just walk in and say, let's wire $100,000 into his account. He's traveling to Bahamas. Look at the way we are struggling here. He is traveling to Bahamas with $100,000. Hey, Kwame. Confidentiality. You can't say that. Oh, Nhyira, so when I get home and my spouse asks me about work, you don't talk about work in the house. When you get to the house, talk about housework. Talk about house things. Oh, honey, how was your day today? My day was great. Is that all? Yes. What do you want to hear? It was great. I took taxi and I ate banku and okra stew and I was stuck in traffic for 4 hours. I'm home now. What is it? Can we watch a nice movie? Don't talk about work in a place you're not supposed to talk about. Confidentiality. Now, this is crucial because you see, a lot of things can happen here. Let me give you some example about confidentiality. So let's build up another story here. Let's say that, so we have, for security reasons, let me just keep my name. So we have Nhyira. And Nhyira is the chief finance officer of the company. And Nhyira attended the board meeting. And Nhyira heard that the company is about to make a decision in 3 months. So there is a strategic announcement coming up in 3 months. Please stay with me. In 3 months. Nhyira heard that and went home to his wife, Kukua. So immediately Nhyira got home, Kukua was like, oh, honey, how was the day? He said, today we made, the company is about to make a decision. Then Kukua said, hey, then this is our will. The pension fund that we have, that money that we have, can you go and liquidate it and go and buy some shares of the company? So that when they make the announcement, the share will go up, then we can sell it and make some money. Then Kukua also, as a good wife, she goes, liquidates the investment, bought the shares. 3 months later, the announcement was made and the share price went up significantly. Then, 6 months' time, they tried to cash out and took the money to enjoy. This is a breach of confidentiality. And this is called insider trading. You will be jailed. And somebody will marry your wife for you. That's insider trading. Because you used an information that is not available to other shareholders and you leverage that to make an investment. And so the reason why this can be found easily is because there is always a tracking that is done. So sometimes, anytime a company makes a significant policy announcement or policy decision, the Security and Exchange Commission go behind transactions. They can go like 6 or 8 months back to find out what the trades that occurred about selling of shares and an acquisition of shares. Then immediately after the announcement, the transactions that occurred about the shares. If there is anything that flags, smells, brings in some related party issues, that's where insiders trading is flagged. And that's a breach of confidentiality. So in your mind, you are saving money. You are building wealth, but you go to jail. Now imagine you didn't say this. So later on, the company makes the announcement and the share price goes up. Then you go home again and Kukwa is like, hey, Ishi, how was your day? You say, do you know that before this announcement, I was in the meeting when they made the announcement? Imagine what Kukwa would do, the average woman. You knew this thing. You knew this thing. You couldn't let us use it to come out for this poverty that you have put me inside. What kind of man are you? Your heart, your soul doesn't like any good thing. We could have used this to cash out. Is she right? Yeah. But you shouldn't have told her. That is why confidentiality is crucial. And that's the principle you must understand. The professional accountant must not disclose information to third parties without a prior notice of the entity unless he has a professional or legal duty to do it. Your wife is not part. The boys you drink with at the weekend is not part. The people you play golf with at the weekend is not part. Safeguard the information. That's the concept of confidentiality. So does it mean you can't talk? No. There are exceptions to the rule. So where can the accountant talk? A number of exceptions here. Number one, disclosure is permitted by law and authorized by the client. Then you're under obligation to say it. There is a professional duty or right to do it. Or you are a witness in a court case and you stand in the box before my lord, the judge. Yeah, you don't need your boss's permission. You have to say the truth so that they can take you out quickly as soon as possible. So those are the exceptional circumstances under which the professional accountant can speak. Other than that, zip your lip. Some of you talk too much. You talk too much. From today, keep quiet. Keep quiet. You don't have to tell your wife, your husband, your girlfriend, your mother, or your boyfriend the things going on in your office. This is the reason. You see, anybody you call your best friend now also has someone they call a best friend. Don't be deceived. Don't think your best friend, you are also their best friend. No. So you think, oh, this is the love of my life. I trust her. She will go and sit at the salon with her girls, and she will spew out that. Or sometimes that relationship will come to an end, and now they can use that information against you, and that could result into significant issues later. And nuntina, you got to keep quiet. Me dear, me to me fa say me shema me yemo. Me dear me kan na maka. Yeah. Koso anaka. Ye de agbalagba be shi utrim na ohun say enya asem bia na yeka. But that's the idea. Then the last one is professional behavior. This is where everything comes together. It simply means that the professional accountant must comply with the laws, regulations, and do not act in any way that brings ICAG or the wider accountancy profession into disrepute. So when you do something like this, insider trading, and it comes out that it is the chief finance officer who did that with their wife, people will not trust. So when the banking sector cleanup exercise came in, people were asking, who are the auditors? Who are the accountants? Like you see the financial statement of Unibank and the kind of reports they were sending to Bank of Ghana. I was like, so they had accountants? They had auditors? And they were having fraudulent financial statements, false financial statements like that being sent to the Bank of Ghana, and nobody highlighted it? That's a disgrace to the profession. Do not break the law or act in any way that brings the profession to disrepute. These are the 5 fundamental codes, the moral principles to guide the behavior of professional accountants. Any questions? Any questions? Any questions? Sir, please, in the case of these auditors in the cleanup exercise, what if they were under duress? No, you shouldn't allow anything, right? That's what we are saying. You shouldn't allow anything. Then you walk away from the audit. Yes, that is intimidation threats, what you just mentioned, because there are threats to the code of ethics that we have to know about. One of those threats is the intimidation threat. Okay? Where you could be agbalagbet. So let me bring this up quickly, then let's go through it. so I can address that. So what are the things that may prevent the professional accountant from adhering to the code of conduct? I've already spoken about some of the scenarios, but they are classified under 5 key themes. The first one is the self-interest threat. Now, the idea about self-interest threats refers to the risk that a financial or other interest will inappropriately influence the professional accountant's judgment or behavior. Example, you own a share in the company, right? So if we go back to the example here, Abraham and Emanuela scenario. Let's say Abraham is a shareholder of the company. Would you want the company to go down? No. So you aid in the cooking of the financial statement so that the loan will be received, so the company will go. Would you want to see people selling their shares because the company has made significant losses? No, because that will also affect your wealth of the shares you own in the company. So what do? You cook. So expenses that are supposed to be written off, you will capitalize. Provisions that are supposed to be made, you will not make. Impairments that are supposed to be recognized, you will not recognize. Those things are what we refer to as the self-interest threat. So anytime the professional accountant stands to benefit from the transactions, then they are going to be in the position like this. To prepare misleading financial statement, allow personal interest to override the objective of financial statement, thereby not doing the job in the manner that is expected to be done, professional due care, and then by virtue of that, bringing shame and disgrace to the profession as a whole, professional behavior. Did you see the linkage? Because you should be able to draw the linkage. How the threat is affecting each of the moral principles. You should be able to draw the linkage. The second one is self-review threat. As the name suggests, this is where the accountant is in the position to review what he was involved in preparing. Okay, that's self-review threat. The risk that an accountant will not appropriately evaluate the results of a previous judgment made or services performed by themselves or their firm, leading to a lack of objectivity. So you gave the directive. So Abraham is the head of accounts in their company, and he has given directives on how the financial statement is to be prepared, and they are finished preparing, and Abraham is reviewing that. He is not going to be objective in his own work because he was the one who gave the instruction on how the thing is supposed to be prepared. But if it was prepared by somebody other than Abraham and he was reviewing it, he would have been much more objective than that. That's a self-review threat. Then we come to the next one, which is advocacy threat. This is something that the professional accountant is exposed to because this is where the professional accountant is promoting the interest of the entity and appearing to others that they are representing the entity. So if I come back to the Abraham example, if you pay attention earlier, I said that if this loan was given, Ruth gives the loan to the company, and it turns out that the company presented a misleading financial statement, Ruth is going to sue Emanuela, the company, and Abraham, the accountant. Why? Because Ruth saw Abraham as somebody representing the company and should have known better to protect the interest of the public. And Nuntina, Abraham will be sued. Because if Abraham is assisting Emanuela to negotiate the loan, to present the financial statement, to inform Ruth that, oh, this financial statement is good, then Sebibisia, I have to hold you accountable. You have to be responsible for the outcome of the decision. That's the concept of advocacy threat. Then the next one is familiarity threat. This is where there is close personal or business relationship. So let's go. Another example here. Why will Abraham kowtow to the pressure of Emanuela? Maybe Emanuela gave opportunity to Abraham. Immediately Abraham finished or completed his national service, he was employed by Emanuela in the company. And Abraham had climbed the ladder up to where he is now. Even Abraham, when Abraham was marrying, Emanuela financed the whole wedding. I have done all this for you. Cook the financial statement small. Let us go and take a loan. That will help all of us. You won't do it. That's familiarity trait. So now it's like Abraham owed Emanuela something. So that will now influence Abraham's professional judgment in the preparation and presentation of financial statement. That's familiarity threat. Then the last one is my favorite of all the threats. Intimidation threat. So this is where the professional accountant, the risks that an accountant will be deterred from acting objectively due to actual or perceived pressures, including threat of dismissal or replacement. And that was what I mentioned earlier. Abraham, if you don't cook this financial statement, you won't get your promotion. You won't get your increment in salary. We will lay off 100 people. That's intimidation threat. That's intimidation threat. Abraham, can you sleep at night knowing that your righteousness has caused 100 people to lose their job, and all these 100 people have a family families that they are feeding? Can you sleep at night? That is intimidation threat. Okay? That's intimidation threat. So, for instance, you will be told that, okay, if you don't do it, your promotion will not come. If you don't do it, people are losing their jobs. What do? That's intimidation threat. Or in serious cases, Agbalagba can come after you. Do you know Agbalagba? Agbalagba is where they call you, Menana. Ade amesi you know what I said you should do. Since you don't want to do it, then you are gone. That's Agbalagba. In our part of the world, Agbalagba is faster. If you go to Europe and America, they don't really do Agbalagba. That one, they will let you do suicide. Do you understand? So like somebody will just die mysteriously, then the person has written a nice suicide letter. Oh, I am happy. I don't want to bother anybody again. I have died. Nobody should cry. No. It's a suicide. It's Agbalagba Pro Max. So sometimes Agbalagba can come after you. Now, by the time you are getting to Agbalagba, it means you have really seen some things you are not supposed to see. Do you understand? And this is where common sense must guide you. And I always tell people this. Don't be deceived. Jesus Christ has to run when people try to stone him. After he said that, before Abraham was, I am. That was Jesus, bro. But he ran because he wasn't the appointed time. If they stoned him and killed him, his mission wouldn't have been accomplished. That was wisdom. So you have to understand when it is time to go away. You must know the fight you're going to pick. Because there are some people, as you are trying to be pious or righteous, they are on agenda to Agbalagba you. Do like this. Menana, you are gone. You go and see your great-grandfather. You see you are in a car going home. Before you realize, you are chatting with your great-grandfather whose black and white picture you saw when you were a child. Then you'll be chatting, say, where am I? Oh, my grandchild, welcome. Welcome where? Oh, welcome home. You are dead. So use your wisdom. So you don't die umkwasi death. But these are some of the things that prevent the professional accountants to adhere to the moral principles. Let's bring the discussion home. So what do you do? If you are faced with this scenario that we have discussed here, the Abraham scenario typically, what should the accountant do? What should Abraham do? Because Emanuela is saying that, Abraham, I need some cookings. If the cooking doesn't come, I'm going to lay off 100 people. You're not going to get your promotion. What should Abraham do? So, recommended course of action. In every ethics question, you have to talk about the ethical issues and then the recommended courses of action. What you must do as an auditor. As an accountant. The first thing Abraham must do is to either educate or remind. Stay with me. If the person, the superior, is a fellow chartered accountant, then you have to remind them the importance of preparing the financial statement in accordance with the acceptable financial reporting framework. Maybe they have forgotten. So Emanuela is also a chartered accountant. So you remind her and say, Mom, you remember that the financial statement must be prepared in accordance with the standards. As per IFRS 15, revenue must be recognized not when we sign the contract, but when we have actually done the job. So, Mom, I'm sorry, but we cannot do this. It's contrary to the standards. That is reminding Emanuela, because maybe Emanuela has forgotten. If the person is not a fellow chartered accountant, then you have to educate the person on why what they are requesting you to do must not be done and the consequences of doing it. Do you get the idea? So you remind or educate the person on the importance of doing the right thing. Importance of doing the right thing. Okay? Why must we do the right thing? And the consequences of doing the wrong thing. That's the first thing. But here's the play. Emanuela is going to tell Abraham something that he will regret for the rest of his life. When Abraham comes and tells Emanuela, oh, Mom, you know that we cannot prepare the financial statement. We must prepare the financial statement in accordance with IFRS 15. Then you hear Emanuela, look at you. You were doing your national service and I offered you a job. And you are here coming to tell me about IFRS 15. When I was a chartered accountant, you were in diapers. Who are you to have the effrontery to tell me about IFRS 15? This life. So that is the reaction. And so that is why many people are then afraid to approach their bosses and tell them the truth. Because they will use you as a rag to mop the floor. But that is the first course of action. Remind them or educate them. That may not fly. Okay, so if it doesn't fly, if Emanuela tells Abraham those things, Abraham is going to be hurt. But we still have to prepare the financial statement. So what should Abraham do? Second option. Abraham can seek advice internally. From the audit committee or any equivalent governing body on the subject matter. So now you got to be careful. Abraham, you are not reporting Emanuela to the audit committee. That's where sometimes some people get into trouble. They feel they are right. Remember the example I just gave, right? Emanuela picked you. You are a national service person, gave you an opportunity. Today you have the effrontery to tell Emanuela about IFRS 15. Who the heck are you? Then you think you know. So you go to the audit committee and say, the CEO Emanuela is asking me to prepare the financial statement contrary to IFRS 15. Hey. Opre dodo. Your life will be ruined. And so when the professional accountant is seeking advice on subject matter issue, he must keep in mind the principle of confidentiality. So Abraham is going to appear before the audit committee or tell the audit committee to seek advice on how certain transactions should be treated, not how the CEO has asked him to treat the transactions. Confidentiality. So you got to be careful. Now, if that doesn't work, because the CEO and the audit committee, they are all on the board. So what's up? They play golf every weekend. So maybe they will tell you something similar to what Emanuela is saying. Then you can go externally to seek advice. So you seek advice externally. Sometimes from the ICAG. Again, if you are doing that, confidentiality must be respected. Okay? You need to keep the information confident. You need to be secretive about it. So you tell them about the subject matter issue without name dropping Emanuela, without even name dropping some sensitive information about your company. So this is the issue I'm faced with. My company is seeking to go and take a loan from another financial institution. The CEO is so you see that I'm even committing an error. I'm encountering in a position where I am being told to present financial statement in a manner contrary to what the standards says. What should I do? How should I handle it? ICAG, the committee, the ethics and professional committee will give you some advice. If you come and that one too doesn't work, the last resort is to resign. You seek legal advice and you resign. That's the last resort. But you see, the resigning is a last resort because it means the subject matter is very sensitive. Because there are some issues that are not that material. So even if Emanuela is asking you to do it and you do it, it's not that material, or the risks associated with this may not be that much. So you can go ahead and do it, right? And, next time you make sure it doesn't repeat itself again. But there are some issues that are material where you can't follow Emanuela's advice. So in that case, you resign. But here is the danger. Are you resigning to go and tell Ruth, the financial institution, about our plans to bring misleading financial statement for a loan? Or you are resigning to keep quiet? That's the danger. And so in practice, where people are exposed to most of these things, what they do instead is to sign an NDA, a non-disclosure agreement, where they are going to keep mute for like 10 years after they resign from the job. After that, you can say something. But these are the appropriate course of actions that the accountant can take. So in every ethical question, so for instance, this is your assignment. Okay? This is your assignment. You're going to do this as your assignment. It's going to be posted on the Google Classroom. Okay? A Google Classroom information that was sent since morning. Up until now, only say 5 people or 6 people have joined the Google Classroom. Is it that some of you don't check your email, or your email? What's the problem? So the assignment will be posted on the Google Classroom. And you're going to try your hands on that. Be independent. Now, assignment must be sent as a single PDF file via the assignment email address. Details will be posted as well on the Google Classroom for you to handwritten. Okay, handwritten. So you're going to try your hands on that question, and let's see how you go about it. So in every ethical question, when you talk about the ethical issues, like you talk about this, it says, identify and explain the ethical issues arising from the above case. So you're going to identify the threats, link it to the fundamental code of conduct being breached. Then you talk about the courses of action, what the person must do under the circumstance. Now, the question didn't say, and the recommended courses of action, but in every ethical question, whether it is stated or not, when you talk about the ethical issues, you must tell us what the person must do to overcome the ethical dilemma. And that is what you must understand when we talk about the moral principles that guide the behavior of professional accountants. I'm done. Any other questions? Any other questions? Oh, okay. My time is even up. Can I say me what time still? My time is even up. Sir, please, this NDA, is this signed before or after? No, the NDA will be signed before you resign, right? So since you have reached the conclusion that you are resigning, the NDA will be signed before you resign. And there will be conditions attached to the NDA that 10 years you're not going to talk, or 5 years you're not going to talk. But before you sign all those things, you must seek, that's why we said you seek legal advice. You don't just get up and sign an NDA of a company or for a job, because it can come back and bite you at the end of the day. So on the overall, it is signed before you resign, and then you go after you seek legal advice. That is it. Gifty, I'm going to blow your stomach. I'll blow your stomach. Look at the question Gifty is asking. Please, is the assignment for the FR student or both FR and CR students? Are you not in the class? It's for everybody. Shame, shame, shame on you, lazy girl. You want to run away from the assignment. It's for everybody. Ethics is in your syllabus. You know that, right? Corporate reporting. Ethics is there. So it's for both of you. You want to run away and say it's for only FR. It's for both of you. And the assignment will be presented on Tuesday. Details will also be posted on the Google Classroom. So please check your email. If you're watching the playback of this video, a Google Classroom email was sent to you. Check the email and join the Google Classroom, because assignments, lecture updates on FR and CR, everything will be posted there. So you don't miss any update. Check your email. It is only in Ghana that when you send email to people, you have to call them again that, oh, by the way, I have sent you an email. Oh, can you check your email? Oh, Ghana for. So please make sure you join the Google Classroom, and then details will be posted there for you. So you will submit the assignment on Tuesday at 6 p.m. That's the deadline. So you can submit it before that time or whatever. Please be independent on assignments. Don't go and write some superfluous English and come and send to me to deceive me. I'll put question mark inside and send it back to you. Because in the exam hall, 99.9% of the time, the question you will see, you've never seen it. So be yourself. Based on the discussions we've had, based on the understanding, do what you understand. Do what you can. The script will be marked, will be reviewed next week as we proceed in the discussion. Then we discuss it together. Okay? So be vulnerable. That is how I can help you. But if you appear like, yeah, you call me Goliath, then It's okay. I will see you as perfect, and there will be no room for improvement. Okay? So that's it about that. Enjoy your weekend, and we will meet next week, God willing. Au revoir.